welcome to FOMC! Hello everyone! How are you guys? Long time no see. I have found my suit today. It is that day. How are you guys? I'm just gonna put off the music here. I know it's too much, but boom, there we are. So, hello mate, hello, hope you're okay. Yeah. Is there any doctor in here, or is there any nurse in here? I am not serious. Is there any nurse? Is there any doctor? I have an issue of myself, so if you know, it's nothing bad. I'm just burned. I just burned myself just on before this live. I'm sorry. I should probably just lay in bed and never do anything else. Should never be live. Somebody told me I should never be live, so I probably should never be live. And I just burned myself just before now, so it really hurts. So if I need to rush to the hospital, I don't know. Maybe I will go to. Chris Whitehead says, "Do you have dress pants on or just a jacket and shirt?" Well, I'm not gonna tell you what's the color of my underwear today, so oh my. Muhammad says I'm a doctor. So the problem is I just ate something very hot and the skin is peeling up in my mouth, and I can see, I think it's like 1st or 2nd degree burn, I don't know, but it hurts like a beep. And that's what it hurts like. So I don't know. You did what? Me too. Look me up. Throw up the way the key. Party time! And today we have the FOMC meeting. We're gonna go there. So FOMC today. We have dollar bullishness. We had a fantastic live earlier today. We're gonna be here for a couple of hours. I think it's going to take a couple of hours to go through everything. So we have 20 minutes left until the statement. For those who've been following USD CAD today, what happened? I haven't looked into it actually, to be honest. For reference, that is the statement out of last time. Cool, good on that. We will take that any time of the day. And now they have Atlanta's GDP out of 6.5 from 5.1. That is absolutely mind-blowing. The next thing that I'm looking for is it this one? Yeah, okay, this guy. What's the highlights, Mike? Canada should expect a rising path of rates. Today we mark the final step of the existing emergency policies. We want to clarify, indicate that the rates will increase. There is some uncertainties about inflation. So he doesn't say they're going to increase interest rates, and I think that's why the market went bearish on it. I hope he didn't lose anything on it, and I was wrong. I am going to take full accountability on my initial thought about it. And I'm sorry. We are mindful that Omicron will dampen the spending in Q1, but overall judged inflation pressure are balanced. Okay, so that would make the CAD fall, because I would expect something around the bullishness of it as CAD yen up and down, and that is USD CAD up and down. And it worked out to be the level to buy. That doesn't bother me at all, if you're wondering. That is just okay. We have back now to entry price, I guess, to the upside. So it all depends on what the Fed is going to do now. Are they going to increase? Are they going to talk about increasing interest rate in 2022? Are they not going to? That's going to be crazy if they don't. If they say no interest rates hikes in 2022, market has priced in, I think it's 4 rate hikes. So really important there. So I have a little alone for a couple of days. It'll heal by itself. Just avoid hot, cold. But I want pizza, mate. I want pizza. Pro dollar, Aussie dollar. We can look at Aussie dollar. Then we're gonna create some kind of poll. So assets to follow today. That's a bad. I know it's a bad one, but so which asset do you want me to cover today? Basically, euro as we are going through the meeting. Euro, USD, gold, Aussie dollar. Yeah, I'm gonna go that. So cool. Don't too much movement in the market. Almost like everyone is waiting for the news. Everyone is waiting, and by the way, big money isn't really going big right now. They're just waiting for the actual confirmation that we are going to increase interest rates in March. That is what the market has priced in, 97% chance of a rate hike in March. If that is disappointed, believe me, it is gonna rise. A dollar is gonna fall by a long sled. CJ says I'm kind of soft. I want to be squeezy. I don't want to be. I don't want to be. I don't want to be hard. For you, CJ. Can you re-show the news about cat, please? Cool. There we are. Screenshot time. But because I'm gonna move forward on it. What else? Any pip finders? Ojo, hello. Full moon to the moon. I mean, what was you said? What was you said earlier about cat? Yeah, have fun about that, Michael. I'm glad you enjoyed it. I don't know if you got any out of it. I wouldn't, but yeah. So if you're new to my channel, by all means, the links are at the beginning of the chat box. At the beginning, there is links to my Discord, free for all, for my strategy, for where you can find the pair of points indicator. That is by Joe Balls, who is in the comment section, who is in the chat right now. So if you have questions for him, now is kind of the time, you know? Now is kind of the time. Archie Dad said, you will not want pizza anymore. I tell you, my pizza... Jesus Christ. For those who doesn't know, Arctic Dad is my brother from Sweden. And he has one of the best jokes earlier today in the live. And they're on the edge. They're edgy. I must say. So I don't know if I should say them today. But I said I had an announcement earlier today. For those who have not followed me for more than a couple of days and a couple of weeks and a couple of months, my birthday is coming up 4th of December. No, 4th of February. So just so we are sure that we all know when I'm a birthday. So, you know, because I'm the most important person in this entire world. So that is a Friday next week. Friday next week. That's when my birthday is. So that's when I'm gonna be old. So hope that you show up for that. Well, it's gonna be a live that day. Yeah. So then we should. What should we have? Cake? I don't know. We should have something fun. I don't know. Hello, Emmanuel. Ayo. Hello, Evan. Best jokes are coming soon. Wait for it for real. Oh shit. Forgot his own birthday. Yeah, I do. Oh, Dwayne has 6th. Wow. Then we are a lot of kids in February, by the way. So that's gonna be fun. Guy said December. I don't know. No, I didn't say December. I said February. I think I said February at least. The winner chicken dinner today is Euro USD. Winner chicken dinner is Euro USD. Cool. Yeah. Oh yeah. Okay, so right now we are just gonna chill out. We're gonna have some fun. I'm gonna give you some information, and we're gonna get ready for the FOMC. So, what happened last time, ladies and gentlemen? Do you remember last meeting? I think last meeting was that in November or something like that. That was probably November. Fed. I also have to go to Fed, by the way. Anyways, Fed. Not Fed. There they are, and then also probably need to go back to that one, add that one to new one, then go to meeting calendar as well. And for 2021, it was January. No, it wasn't that one. It was 15th then. Okay, 15th. That is the day around. No, that's not the day. Jesus Christ, I love it. 15th of December, of course. And then that was there. There it is. Okay, cool. That's the last one. What happened then? We went into range. Or we were in a range, continued in a range. The previous meeting, we were 3rd of November. I'm gonna just put there-ish. And then 2nd of November, 2nd, 3rd of November, around there. Okay. So, markets. Markets can go higher. Dollar can fall today. Do not worry about that. The question is, what is going to happen next? All right. We have a clear winner, chicken dinner. We have 54 votes, only 84 viewers, so it's okay. I can delete that now. We have a winner, chicken dinner. It is Euro USD. Cool. Mine is on the 13th of February. Very much welcome to the February clan, Nidika. It's Friday, and it's Friday. It's Friday, Sunday, Saturday, Sunday, Monday. It's Friday then. I can't remember the rest one. That's all I remember. Cool. So, this today we are expecting a hawkish Fed. We are not expecting them to update their plot, their dot plot. What does that mean? Dot plot is their opinions, and it's shown in a dot as to when they want, how many interest rates they are expecting in 2022, 2023, 2024. And now also 2025. 3 years, I think it is. That is not being updated at this meeting. It's going to be updated next time. The two very easy questions is, are Fed going to signal increase in interest rates for 2022? And at what time? Is it going to be March? Is it going to be May? Is it going to be June? When is it going to be? Are they going to announce the end of the QE program? Are they going to end it today? Or are they going to end it next week? No, not next week. Next meeting. Those are that's all the questions that is out there. I'm going to show you. I need to go to Twitter because that's where I found it. What's that dude called though? And maybe notifications probably, because I got notifications about it, but of course it's I'm not following him here. Okay. Then I'm just gonna run as fast as I can. I'm gonna be faster. What's that guy called? It's the guy from Daily FX guy, and he's not here. So I think it's on my other Twitter account. He posted this chart here. I'm just gonna find it because I posted it here, and I need to give credits to him. I haven't, so there we are. So as we sit here today, it's his own. I think it's called Michael. I will have to find out where he is called so I can give him credit. March hike. Market has probabilities of 97%. That is very bullish for dollar, very bearish for the S&P. Today there is says there's no likeliness of no change. There is going to be very bullish if they rate hike today, which I find extremely unlikely. The next question is, are they going to be rating 4 rate hikes, forecasting 4 hikes this year? Market has not priced, I think market has priced in 4 hikes, so that is around 97, 98 as well. It is bullish and is very bearish for the stock market. Now, what does it do? Is Powell going to say that inflation is going to demand action? That's a very bullish dollar. It's a bullish dollar. Tolerance for market volatility instead of inflation needs action. That is very bullish. COVID-related uncertainties, they're like, nah, not so much. That is neutral for dollar. And you can also see, the same thing for S&P. So we can all read the chart. I'm just going through it so you all understand what, and this is his probabilities and the impact on dollar. How likely is he going to talk about that inflation is that needs action? I would put out my own put my own there at around 90% chance he's going to talk about that inflation needs action. Because if they don't say that, then why are they going to increase interest rates at some time this year? Are here people who try to trade the upcoming move? I'm probably not going to enter a trade, but I already have trades open, so I'm expecting to hold those. But sure, we can always put up a 0.01 lot just for fun of it, but just to do it. But not going to be a financial gain, just for the thrill of it. Remember, fastest way getting the dot plot without going through the meetings documents is just to watch the squawk. Financial Jews post a picture of it once it's out. No. Like, what do you mean, bro? I'm following Sarah H, Mr. Beast, Forex Live. Like, what's the matter with you, Karen, Kathleen? Just normal operating procedure. I don't know. What do you guys use? What do you guys use Twitter for then? Eh? You shady people, eh? Was this guy? So I can give him the credits. That's the guy. John Klingler, Kicklater, I guess it's called. So yeah. So key for him is, do they talk about 4 rate hikes? Do they signal a March hike? Are they willing to weather the volatility and all those things? So, what's the next? And also, the dot plot is also being produced in the CME group as well, .com, and it is shown. It's shown here either as a chart or yeah. What the? Okay, so people, just asking yourself before we go forward, what's the resolution at the moment? My computer is bothering me about 720. Dollar up. Omer. Pretty straightforward there. Nothing in between there. I don't know if mine uses something, but there we go at least. So that's kind of me for before the meeting. I think I don't know if we are well prepared, but we are at least prepared. And I am going to go to economic calendar so we all can see that. And then I'm going to move myself around and we're going to have fun. So just let me entertain you. Baby boo. Let me entertain you. Okay. And then we need to have economic calendar. There we go. And there we go. I'm just wondering where I am. I am there. We are good. And we are good. And we are good. We are 3 minutes away. And then I will have the Fed up there. And I'm going to take that away. That's where it is. Monetary policy. So just going to wait for that one to be updated here. So, good to go, I? Good to go, I? Yeah. I guess that's okay though. Where are you guys? Where are you guys at? There you guys at. 1080. Okay, cool. Then I'm good because I tried to do that. Holding a CAD trade over the news. All I can say, wanna. for those who doesn't know what he just said, and I'm gonna not translate it for you because I'm gonna translate it for myself first. So I'm just making sure that yeah, okay. So I understood it correctly then. Bwana ni mwagozi mwangu. Any chance of increasing your mic volume, please? Is my voice working me low? I can always go higher. Is that good enough? It's on. Fine. Better then. Oi. So we can show my 2 minutes of statement. What about investing in gold? That's probably I will save you some hard-earned troubles. I won't. But yeah, okay. Good. Kiswahili. Hapana we. So we are good to go. We're all set and done. We're just waiting for that and that and that and that, and then I will be the first one to. Should we probably? I would just take it over here, I guess. So yeah, good. I don't see you guys at the moment though. So we're just gonna do that right now. It's on. So let's see how things is gonna go now. Just waiting for. It's not Kiswahili. It is Kasawa. It is. When is the market open? Where's the market coming? It is in 15 seconds, 10 seconds. 9, 8, 7, 6, 5, 4, 3, 2, 1. Lift off. Refresh. It's not open on my chart at the moment. Dollar is rising a bit. There's a statement. There we go. Yeah, something happened there. Yeah. Fed still the same. Page not found. What do you mean? Why is it not found? Okay, the whole thing just crashed. Is that what you're saying? Hakuna Matata. What a wonderful phrase. Hakuna Matata. All passing craze. It means no worries for the best of your days. There we go. Indicators of economic activity has continued to strengthen. Sectors most adversely affected by the pandemic. They're not talking about a hike. For the beginning of February, committee will increase its holdings treasury by at least 20 per month, mortgage-backed security by 30, so they still couldn't by 30. The reserve's ongoing purchase holding securities continue to foster smooth. Nothing new there. The path of the economy depends on the course of the virus, progress of vaccination, easing supply constraints, whatnot. Jobs has been solid in the recent months, and the employment has declined sustainably. Supply and demand imbalances related to the pandemic and reopening of the economy have continued to contribute to elevated levels of inflation. Good. Everything is great here. Everything is great, though. So, what's the motto then? There's nothing else then. We should be ready for rate hikes then. We definitely should be ready for rate hikes. Dollar is currently going a bit up. Dollar is currently falling a bit. Euro is going a bit up. Market goes up. Yeah. But what else? Be prepared for the US to stance on monetary policy. So they are not so far talking about interest rates. That's probably what I didn't get what I wanted. So let's go to financial juice as well. In early March, we will bring an end to the bond purchase. If risk arise, obstruct the Fed goals, they're prepared to change. Yeah, okay, good. Also, what else am I reading then? What does this mean? This means that in all terms and conditions, this should lead to dollar bullishness in the end. If somebody reads this differently than me, March will end QE, and that has been the whole thing the whole time, right? That's been the thing the whole time. So that is there's no differences there. Yeah. I would say that's probably what's nice to see, and just removing that guy. So yeah. Rates soon, but no time mentioned. That's probably dollar weakness by all means. By all means. But if you look at the markets right now, just gonna have that next to each other. Let's see what we can do. Who is talking to me? Like who? Oh yeah, somebody subscribed. Again. He subscribed. Junior, Dave, welcome. Welcome to the family, bro. I got scared. Jesus. Oh, every time. I need to learn my own notifications here, people. I'm sorry. If you look at the dollar right now, dollar is currently rising a bit, and I'm just going to move that one all the way back so we can see the markets here. Dollar is currently still rising. The progresses of the vaccination easing supply chains are expected to support continued gain in the economy. So what I'm actually seeing here is that what stands out for me is it's that they're seeing that the labor market is growing sustainably. That's kind of the key takeaway from me. Yeah. Monthly QE will end in March and in early March. That's kind of what I expected it to be. So they are not there, and dollar is rising at the moment. S&P is also going higher. Interesting, fair enough. And stock market is rising, and I would actually be very that's very interesting. Mr. Sai here, Ahmed says, look at gold. Okay. That knocks me out. Sorry, bros. It was fun while it lasted, right? So that's a good night there. So gold is currently falling, and nothing we can do about that, I would say. So yeah. Look at gold. I'm looking at gold. It's dancing. It's going lower. So I'm out of there from there. I'm out of there from me though. So you won't see me buying this one right now. And again, Forex News on Telegram says we expect the balance sheet decline to begin after the interest rate hike process begins. We expect the balance sheet decline to begin after interest rate hike begins. That is interesting. We will rise interest rates soon. That is a very hawkish thing to say. So by all means, I am still in the process of getting what I want from everyone here. So, but if there's nothing else that is looking out of, that is kind of good. Aussie dollar went a bit higher, and now falling a bit back again. Thoughts on Aussie dollar? Just give out your pair, and I will look at it as fast as I can. Aussie, I think it's gonna fall. I still have my sell. For those who hasn't been a part of it, I sold that one on Thursday. It was a pending order. 6 days ago, I sold it, and I took profit at 71. And you're wondering, well, Eivind, did you ever tell anyone? No, I did not tell anyone about that. I went to this one, And okay, I can't show my own charts. Okay, cool. Sure. I said sold, and there we go. Sold. Where did I sold? Sold at 72.66. Take profit at 71. Take profit as planned. So, yeah, all good on that one, I would say. So, just waiting now to get a better interest. Chief! Horek! Where have you been? I thought you died! Bro! Where have you been? Oh, you were talking about me being soft, but that guy I'm soft for. How are you? I'm good. I'm alive. I've had COVID. I just burned myself in the mouth and I'm in pain, but I'm still here. I'm still here. I'm still alive. I didn't die, bro. Look at Euro. We are falling again. Yes. I wanted to be higher though, but still. I miss you. Yeah, you're gonna call me. My phone is here, bro. Come on. Yeah, I got COVID. I was down. Shit. But yeah, I was down.
Of every day.
We keep calm and eat cake.
Of every day.
Keep calm and eat cake. Yeah, that's why I'm a Viking. That's what my name means. It means warrior, by the way, people. But yeah, we are ready to change any details on the balance sheet if it doesn't work out. Okay, whatever. That's what I always say, anyways. But pound, okay, that's 35.17 if you took that one. But yeah, So Mr. Ant talked about yen pairs earlier today. I sold Aussie yen here, so we shall at 82. So we shall see if I will be right about that one. USD CAD is asked by Casa Luis. I'm not trading that one. It is not at a good level, not where I wanted to be. Shoot on what do you mean by trading settings? That would be nice to know. Maybe it's lost in translation somewhere. But I sold Aussie yen out of somehow a resistance, coming back up to central on the weekly and continuing low. It's a bit aggressive, of course. Of course, it's aggressive, but I'm waiting this one to continue falling down. So if it doesn't work out, then we will just continue moving on. Coming back to Euro USD, my computer is a bit slow at the moment. Yeah, okay. USD Swissie, we can look at USD Swissie as well. Just mentioning the Euro. Euro right now is back at entry price. Nothing has moved on Euro other than a couple of spikes up and downtown. That's a bad story, but fair enough. USD Swissie just went away from me earlier this week, and I don't know what happened. I don't know why it didn't trigger me to buy or call up a buy here and call up a buy here, but it is what it is, and that is the buy price there. So it's definitely a long time ago, 91.25, and the target is right now is at 93. So yeah. I think it's okay. I think it's okay trade, but it's definitely out in the darkness, and frankly, we didn't follow it, so I can't really take credit for anything out there other than it being too high. Canadian shorts thoughts? I don't have any thoughts on that. Hey, Mentor, how are you? We're doing today. We're doing good. CAD-yen is at the moment a bit up and down, up and down, 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 up and down. So there is no real trend on CAD-yen. Well, maybe that is a buy by all means. So shorting opportunity, I will not short CAD at the moment. So still holding all my sales until March. Yeah. Are you happy, mate? I am absolutely godsmacked happy. Do you know why I'm happy? I'm happy because you are here. Okay? Nobody laughed about keeping calm and eat cake, but okay, cool. I will enjoy my my jokes a bit more. But But yeah. Just taking away that one so we can see more of you to you. So if you're here for the laughs and jokes, which we also do in the live, yeah. Which one can I even show anything? No. Everything is like X-rayed here. But yeah. We will look at it one other day. And I don't want to be smacked with the content violation either. Are stocks finally falling now? Tja. Facebook, FB, what is FB doing? FB, yeah, okay. Maybe-ish. Tesla. Okay, still green though on Tesla on the 1 hour. But fair enough. Google. Still green. Okay, fair enough. Thank you for being here, Eivind, during the FOMC lives. Much appreciated. Being between you, Joe Abbas, and the whole community, we are blessed. I am extremely blessed to have you guys here. And for those 122 people who's here right now, I'm just going to say one thing. The reason why you don't see much trade setups from me right now is because I have already done what I wanted to do this week. That is selling up here. I probably can't sell it here again. Euro isn't that low, so if it comes back up again, I am going to update you on the next sell I'm going to take on the Euro. I did sell Aussie Yen earlier today, or not early, but at 82, so that's a good sell there. But other than that, I'm just, waiting somewhere in between, Also, I said 76.65 earlier in the live earlier today, so if you took that one, congratulations, you're currently in profit. What is your call on gold? I had buys up here, and, that's now being stopped out. So that's kind of gone right now. And then, so I have no Sahir. Why do I not have anything? Because a move lower is not considered to be a good move for bulls. So, and it fell pretty hard. So I'm just waiting for this one to settle down, find its place, continue on, and be on its move to either upside or downside. So if it goes up, I will continue to come back to it. But also, if it then continues to fall, I'm just gonna be looking at it on the sideline. I'm gonna be happy about it. Anyways, Forex Live is down. Oh no, maybe it's down. And then news here. Is there any news? Breaking: Fed leaves rate unchanged. Says it will be soon appropriate to raise hikes. That is what I also read out of it. So, bond buying will end of March, beginning of March, sorry. Fed will prepare to adjust the stance if appropriate, whatever. Of course, they will always assessing the situation. Supply and demand imbalances related to the pandemic and reopening of the economy have continued to contribute to elevated levels of inflation. They're going to increase treasuries by 20 billion and 10 billion in February. That is 30. That is the same as last time, as far as I know. The Fed expects that reducing balance sheet size will commence after the process of increasing interest rates. Okay. Fed reaffirms in an identical statement that longer run goals and policy strategy adopted in 2020. Yeah. The only one is coffee. I have coffee from the last live. Does that matter? It's a bit cold now. So, woohoo! That wasn't nice at all. Let's see, Mr. Transitionary will say in 14 minutes. Somebody subscribed? Wait, who are you? Ifai Azaba. Sorry, Ifai, I'm sorry. For those who has, not weird, but for those who has a bit tongue-twisting YouTube names, I do apologize for eternity that I don't make you don't make a correct explanation. If you come to a Zoom meeting and you tell me how your name is, I will gladly practice as long as I need to say it correctly. I will always try. Now see if Powell sounds hawkish or goes dove to protect his own stock portfolio. That, my friend, is an intelligent, high-level comment coming from Denise. Thank you for being a YouTube member of my YouTube channel. Thank you for being here, Denise. I think that is interesting. What I find to be very interesting is that two Fed members had to go because they were trading the markets. The market there themselves has made risk-free until now. So, what are we going to do about it? Nothing. So, nothing happened to them. I haven't seen them in jail. They're like, well, let me just walk out of the door. Who cares anyways? So let's just not bother ourselves with have integrity, to be open and transparent. We also have to make money. We are, so. And I guess this Powell also has his own portfolio somewhere through someone that is probably not known. So yeah. I clicked the link, sorry, kind of late. I said it first. When do you hold your Zoom meetings? I'd like to attend one. So, Le Bougang, I do have Zoom meetings for free for everyone at around 11 p.m. That's in 3 hours, generally speaking. That's because I have a daily setup in around 10 minutes from now. In around 10 minutes right from now, every single day, Monday to Thursday, in 10 minutes. But not today. So, trader news. Welcome to the family. Happy to have you here. That costs like $30 a month, I think it is. Plus taxes if you're in Europe or UK or America, but not everyone else. As far as I know, but yeah, it's on the internet. And you probably didn't ask, but I'm probably going to tell you anyways. It's this one, and that's the link for those who bothered. So we go through our setups every day, and I tell you what I will do and what most important thing. So if you don't join my lives, that is where you update. That's what you kind of need to do every day to update yourself on the markets. That's all. You don't need to be on the lives. You can just be on that one. Traders News says, thank you, Eivindfx, for live coverage of FOMC. Yeah. What else should we talk about now? We should probably talk about that the fact that they have actually said that they're going to go and that they are going to increase interest rates. I think that is the most important thing of today. So if I'm going to make any video, I don't think I'm going to make a video today after today, but that is sure very important. So if you are a fundamental trader and you're like wondering, Eivind, what are you talking about? Sometimes you say fundamental analysis. What do you mean? Let me tell you here, bro. So the first sentence, all the time. Indicators of economic activity and employment has continued to strengthen. That is a bullish sentence. What do they mention the first? Indicators of economic activity. Indicators. Then you have to look at indicators of economic activity. And employment, then you have to look at employment. The next they then say is sectors adversely affected by the pandemic has improved in the recent months. What do they look at? The sectors that has been affected by COVID. What is that? That is service, that is airlines, that is everyone who was closed down because of COVID. Job gains have been solid in recent months. That's a very bullish move. That's a very bullish statement. And then you go through every single thing. What do they mention first? they mentioned first that they are going to achieve maximum employment around 3.4, I think it is, and inflation are the most important thing. That is where I get my understanding from, what I need to look at. I didn't make up myself. I just read this report a couple of million times, and then every time it becomes a bit easier than the last time. And then you can ask questions. What does this mean? What does that mean? It's a difficult language, but this, people, is fundamental analysis 2.0. Probably not 1.0, but this is where I get this is where I get everything I need to know, that what I want, that the Fed is communicating to the market, and that's how they move the market in the direction they want. Quote, in March 2020, they sent the interest rates downtown. They sent the QE program to the moon because they wanted the market to recover, to not be unstable, to not have a lot of volatility. And what happened? It created the biggest bull market in history. So, USD CAD has been asked a couple of times. I have seen you. I do not see you, but I've said earlier today. So, that is the bullish move. That is a bearish move. I don't sell CAD. If I was to buy this one, I can't sell CAD because I'm fundamentally bullish on it. I'm fundamentally bullish on the dollar. So, where is this one most likely to go? Sideways. Now, USD CAD has a good setup for buyers. That is technical. Technical analysis 101, nothing else. So, if you really want to look for a buy, have a good run. I'm not going to chase you on that. I'm not going to say you against you. I'm just going to say, if you want to, have fun. I'm not going to. The other one is, can you sell this one? Maybe you can sell that 121.2630, but I won't. Why do I not want to? Because I am fundamentally bullish on both. The next thing is, if dollar weakens, can we see that? Are you going to sell that? I'm still not going to sell it. Now, if you are coming to my live and you're saying, Eivind, why are you so strong opinion? Because that's why you're here. Because I'm trying my best, being lovely, I'm being loved, so I'm showing you love here. I will not trade USD CAD because there is no clear direction fundamentally. That is the fundamental reason for why this one should move. So, if I cannot see a clear path for what is going to move this market, why should I trade the market? Okay? So, for those who ask for USD CAD, I would love for you to find something else to look at. I can look at CAD yen. I can look at the Euro CAD. I can look at Pound CAD. But right now, USD CAD of the dollar pairs are probably the one that I will look at least amount of times for the least amount of seconds, because I don't know where this one is going. But technically, it's bullish. Have fun. Okay? Yeah. So much insider trading in the US government and nothing is done. Yeah. And what was it? Was it Nancy Pelosi that wanted to not ban trading, but like make it difficult because she lost money in the stock market? Or some sort. So for those 125 people who is here right now, have I given you any knowledge, any value, any direction whatsoever? I hope that you find your way to the like button and the boop button and also the subscription button. That's the last time I'm going to say that. I don't want you to subscribe to me if I have not given it to you. But I've tried my best. Okay? I have tried my best. So we are going to go to YouTube. We're going to go to Federal Reserve. And their and their YouTube shenanigans. So we are ready, early, willing, and able. Okay, so we shall see how loud is it. Okay, it's very low. Okay, we will just be there. Okay, cool. I'll take it off. So, cool. Navid says, look at CAD yen. We will look at CAD yen. I haven't. Sorry about what about Aussie dollar and Aussie yen? I have looked at that many times. I have already sold Aussie yen a couple of hours ago. Aussie dollar, I am still waiting to come back a bit higher before selling it. Elizabeth Warren wants to stop trading because she says it's corrupt against the American people.
Let's see what she can do.
Who subscribed? Who subscribed? Empty Sounds subscribed. Boom. I love everyone who's here right now. Thank you very much. So should we crack some jokes now, just in a couple of 2 minutes before it all breaks loose? Finally, peace. How about Pound Aussie? We can look at Pound Aussie and CAD Yen. CAD Yen. I think we looked at CAD Yen. It is currently bullish or bearish there, but bullish action at the moment. And 90.50 was a great buy, I guess. And then you just wait for a new high, pull back, good to go. Up to that resistance there, and then you need to evaluate if this is going to continue higher. Your insightful info has helped me a lot, especially with my psychology. I used to enter prematurely, but now I wait for my setups. Thank you very much, says Labungo Gang. Thank you. I am humbled. Can you do a little bit of analysis on pound? Is it going to remain bearish in Feb? I think it's going to go higher. I just don't know when. And yeah, it's probably bearish because of dollar strength, or it's weaker because of dollar strength, not because of its own weakness. If you're waiting for Aussie to come up again, why did you sell Aussie yen? It's two different pairs, bro. But yeah, it's two different pairs. One is Aussie dollar, and the other one is euro. It's a setup. It's not the asset. It's not Aussie against yen or whatever. So yeah, okay. Time.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected, as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong, job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. In addition, we believe that the best thing we can do to support continued labor market gains is to promote a long expansion, and that will require price stability. We're committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. And we'll be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer-run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals. To provide greater clarity about our approach for reducing the size of the Federal Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. For the first question, we'll go to Chris Rugaber at the Associated Press.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred to in my opening statement, it is not possible to predict with much confidence exactly what path for our policy rate is going to prove appropriate. And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015. Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate. The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that are highly uncertain, and that inflation has persisted longer than we thought. And of course, we're prepared to use our tools to assure that higher inflation does not become entrenched.
Thank you. Let's go to Nick Timros at the Wall Street Journal.
Good afternoon, Chair Powell. Nick Timros at the Wall Street Journal. I have a couple of questions on the balance sheet. The statement on the balance sheet today calls for significantly reducing your holdings. What does that mean? And then, apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales, or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, but and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to more of the details that you're asking about. I would say this: the balance sheet is much bigger. It has a shorter duration than the last time, and the economy is much stronger, and inflation is much higher. So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rate increases affect financial conditions and hence economic conditions. Balance sheet is still a relatively new thing for the markets and for us, so we're less certain about that. So again, I think the pattern we'll follow is to arrive at a timing and a pace and composition and all those things, and then announce that with advance notice, and it will start in the background, and then we'll look to have that just running in the background and have the interest rates again be the active tool of monetary policy. That's at least the plan. I can't tell you much more about any of the very good issues about size, pace, composition, those sorts of things. We'll be turning to all of those at coming meetings.
Thank you.
Thanks. Now we'll go to Neil Irwin.
Thank you, Chair Powell. It's Neil Irwin from Axios. Glad to be back. Sir, I was wondering if the volatility we've seen in financial markets in the last few weeks strikes you as anything alarming or that might affect the trajectory of policy? Conversely, to the degree that financial conditions have tightened some, might that be desirable in some ways in achieving your tightening goals?
So, as you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations, so that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year or hi. Thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements referenced the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next step and the next step?
Well, you're right. We haven't gotten to that point yet. We haven't made a decision yet, and we'll make that decision at the March meeting. We'll make a decision whether to raise the federal funds rate. I would say that the committee is of a mind to raise the federal funds rate at the March meeting, assuming that conditions are appropriate for doing so. We have our eyes on the risks, particularly around the world, but we do expect some softening in the economy from Omicron, but we think that should be temporary, and we think that the underlying strength of the economy should show through fairly quickly after that.
If I could follow, just on a related question, the December SEPs had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
My path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will be providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek. let's go to Gina. Okay, let's go to Steve Leisman.
Thank you, Mr. Clinton. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at next upcoming meetings and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of the technical question part of it. The principal question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level, to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done. That's going to take some time. We want that process to be orderly and predictable. And so those are some of the ways I would think this lays out our, the way we're thinking about this. In terms of the timing, I can't really help you. It just says after we get underway. So I would say we're going to have another discussion at the next meeting, and my guess is we'll have at least one other discussion at the meeting after that, and we'll tell you as we make progress, and we'll start the process of allowing runoff and shrinking the balance sheet at what we find to be the appropriate time. I wish I could say more, but honestly, we haven't made those decisions, and we actually haven't even really had the important discussions on a lot of the details that we will have at coming meetings.
Thank you. Let's go to Craig Torres.
Chair Powell. Chair Powell, good afternoon, Michelle and Chair Powell. Craig Torres from Bloomberg. Chair Powell, at the beginning of the conversation, you said risks are two-sided. And I'm wondering if you can elaborate on what are the risks to the elusive soft landing? Is Fed policy a risk over tightening, or what are the risks? And then second, Chair Powell, I have a quick administrative question. Robert Kaplan's disclosure of his securities transactions, in a couple months, Chair Powell, or maybe sooner, you and I will file our tax returns and we'll list transactions and all kinds of things. And next to those transactions, we'll put dates. And Bloomberg asked for the dates of Mr. Kaplan's transactions. The Dallas Fed is not giving us the dates. And I don't see why this is a matter for the Inspector General or anybody else. I mean, why can't he give us the dates? Will you help us get the dates of those transactions? Thanks.
So you asked about the risks first. So the one risk is that inflation risks are still to the upside in the views of most FOMC participants, and certainly in my view as well. There's a risk that the high inflation we're seeing will be prolonged, and there's a risk that it will move even higher. So, and we don't think that's the base case, but you ask what the risks are, and we have to be in a position with our monetary policy to address all of the plausible outcomes, and that calls for us to be in position. We have an expectation about the way the economy is going to be evolved, but we've got to be in a position to address different outcomes, including the one where inflation remains higher. And of course, that is a risk to the expansion. We've been saying that what we need here is another long expansion, which is the kind of thing we saw over the last, which is the record long expansion. We saw labor force participation rise. We saw wages persistently higher for people at the lower end, and there really was no obvious imbalance in the economy that threatened that expansion. It could have gone on for years were it not hit by the pandemic. So we'd love to find a way to get back to that. That's going to require price stability, and that's going to require the Fed to tighten interest rate policy and do our part in getting inflation back down to our 2% goal. So I mentioned two-sided risks. A couple things. One, the COVID is not over, and COVID can continue to evolve, and it's just we have to accept that it's not over, and the risks to it can slow down growth, and that's sort of a downside risk from a growth standpoint. I would point to another risk is just further problems in the supply chains, which could slow down activity, and you see the situation in China as a situation there where that's their no COVID policy may cause more lockdowns, is likely to, and that may play into more problems in supply chains. In addition, there's what's going on in Eastern Europe and things like that. So there's plenty of risk out there, and we can't forget that there are risks on both sides. So that's there. That's what I would say. I know you've been all over this issue with my colleagues, Craig, on the issue of information. We don't have that information at the board, and I asked the Inspector General to do an investigation, and that is out of my hands. I'm playing no role in it. I seek to play no role in it, and I can't help you here today on this issue, and I'm sorry I can't.
Okay.
Thank you. We'll go to Gina now.
Thanks for taking our questions, Chair Powell, and sorry for my tech issues. I wonder if you could tell us a little bit about where your thinking on inflation stands today. The last time we saw an SEP back in September, we saw that you and your colleagues were projecting that inflation would sort of sink back down quite close to target by the end of the year. And I wonder if you still think that projection from December is a reasonable one, and if your thinking has changed at all, I wonder how you're thinking about that. And I also wonder if you could talk a little bit about the pathway to getting to that deceleration. Like how do we get from here, 7% CPI, to where you expect to be at the end of the year?
So I'd say, since the December meeting, I would say that the inflation situation is about the same, but probably slightly worse I'd be inclined to raise my own estimate of 2022 core PCE inflation, let's just go with that, by a few tenths today. But we're not writing down an SEP at this meeting, but I think it hasn't gotten better. It's probably gotten just a bit worse, and that's been the pattern. That's been the pattern. So I think if you look at the FOMC participants, there's a range there, and that range has been moving to the right for a year now. And by the way, if you look at other forecasters, essentially all other macro forecasters who do this for a living, you've seen the same pattern. So what do we think about that? Well, I think we wrote down rate increases in the December meetings, each of us individually. And I think to the extent the situation deteriorates further, our policy will have to address that. If it deteriorates meaningfully further, either in the time dimension or in the size of the inflation dimension. So that's how we're thinking about it. As I mentioned, though, I think it's part of this will be that the Fed, moving away from a very highly accommodative policy to a substantially less accommodative policy, and then over time to a policy that's not accommodative in time. I don't know when that will be. Those are the things that we're thinking about. That's part of it. Another part of it is that fiscal policy provided an impulse to growth over the last 2 years. That impulse will be less. In fact, will be negative this year, and so that's another thing. The other one is we will eventually get relief on the supply side, and the ports will be cleared up, and there will be semiconductors and things like that. Now, what we're learning is it's just taking much longer. So I think longer than expected, and that I think does raise the risk that high inflation will be more persistent. I do think we'll come off of the highs that we saw in the early part of this episode in the spring last year. But really, the question is going to be what is inflation running at, and so we'll be watching that. And our objective is to get inflation back down to 2%. It's also to provide enough support to keep the labor market healthy. The labor market is very, very strong right now. And I think that strength will continue. There's really a shortage of workers. We see it particularly among production and non-supervisory workers and people in the lowest quartile. You see very large wage increases. I mentioned some of the other indicators. So I think that's what we're looking at. And we're also, we realize, I think, as everyone does, that this outlook is quite uncertain and that we're going to have to adapt. And we're going to communicate as clearly as we can, but we're going to have to be adaptable and move as appropriate.
Great, thank you. Thank you. Let's go to Colby Smith.
Thank you, Michelle. Chair Powell, when you talk about being humble and nimble about the path forward for monetary policy, does that also include the possibility of raising interest rates by larger increments and, say, doing a 50 basis points hike at some point if inflation does not moderate sufficiently? And should we interpret this approach as a departure from the gradual pace that we saw during the last hiking cycle?
So, as I mentioned, we have not made these decisions. We really haven't. And what I can tell you now, though, is that we fully appreciate that this is a different situation. If you look back to where we were in 2015, 16, 17, 18, when we were raising rates, inflation was very close to 2%, even below 2%. Unemployment was not at our estimates of the natural rate, and growth was in the 2 to 3% range. Right now, we have inflation running substantially above 2%, and more persistently than we would like. We have growth even in forecasts, even in the somewhat reduced forecasts for 2022. We still see growth substantially higher than what we estimate to be the potential growth rate. And we see a labor market where, by so many measures, it is historically tight. I think in a way, the least tight aspect of it is looking at the unemployment rate, which is still below our median estimate of maximum employment. If you look at things like quits and job openings, as I mentioned earlier, and wages, you're seeing, and just the ratio of job openings to unemployed, you're seeing a very, very tight labor market. Now, we also know that labor force participation is significantly lower. It's a percentage point and a half lower than it was in February of 2020. Maybe a percentage point of that is retirements. Some part of those retirements are related to COVID rather than just regular retirements. So we think there is a pool of people out there who could come back into the labor force, but it's not happening very quickly, and it may continue to not happen very quickly as long as the pandemic is on. So that's how we think about that. We haven't made, to your specific question, we really have not addressed those questions, and we'll begin to address them as we move into the March meeting and meetings after that.
Let's go to Rachel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can talk to us about any metrics that the Fed uses to assess how inflation affects different groups of Americans, especially lower income earners. And are you worried that the Fed underestimates or can't effectively measure the impact of inflation on some of the most vulnerable households? Thank you.
So it's more a matter of, I think the problem that we're talking about here is really that people who are on fixed incomes who are living paycheck to paycheck, they're spending most or all of what they're earning on food, gasoline, rent, heating, things like that, basic necessities. And so inflation right away forces people like that to make very difficult decisions. So that's really the point. I'm not aware of inflation literally falling more on different socioeconomic groups. That's not the point. The point is some people are just really prone to suffer more. I mean, for people who are economically well off, inflation isn't good. It's bad. High inflation is bad, but they're going to be able to continue to eat and keep their homes and drive their cars and things like that. It's more so that's really how I think of it. And we have to control inflation for the benefit of all Americans, but part of it is just that it's particularly hard on people with fixed incomes and low incomes who spend most of their income on necessities, which are experiencing high inflation now.
Thank you. Let's go to Edward Lawrence.
Thanks, Michelle, and thank you, Mr. Chairman, for taking the question here. So year over year, inflation's at a 40-year high. The input costs for producer price index for all of 2021 was the highest on record. Some investors fear that the Fed might be moving too late. Now, you said no decisions were made on the path of rate hikes, but was a rate hike more than 25 basis points discussed today? And as a follow to that, because I have problems with the mute button, as a follow to that, you testified that the supply chain issues could be worked out by the end of the year. You talked about that today. The CEO of Ford, though, told Fox Business today that the chip shortage will last into 2023. So today you said inflation will start to ease this year. I want to drill down and get a timeline that you see as to when we could see that relief. Thank you. So
I would not say that I would expect the supply chain issues to be completely worked out by the end of this year. I do not expect them, and I have not expected them. What I would say, and I have been saying, is that I expect progress to be made in the second half of this year, mainly. Progress, because we're not making much progress. If you look at a ton of metrics, you can find some that suggest that delivery times are shorter and inventories in some industries moving up, but overall, we're not making progress. And things like the semiconductor issue they're going to be quite a long time. I would think they'll go more than through 2023. In terms of being too late, I would just say this: our policy needs to be positioned to address the full range of plausible outcomes, as I said, and particularly the possibility that inflation will continue to run higher more persistently than we'd expected. And we think we are positioned to make the changes in our policy to do that, and we're committed to doing that. And that's really where we are. In terms of your question about the size of rate increases, we haven't faced those decisions. We haven't made them. It isn't possible to sit down here today and tell you with any confidence what the precise path will be. But as we work our way through this meeting by meeting, we are aware that this is a very different expansion, as I've said a couple times, with higher inflation, higher growth, a much stronger economy. And I think those differences are likely to be reflected in the policy that we implement.
Thank you. Let's go to Mike McKee.
Thank you, Mr. Chairman. I'd like to sort of weave some of the strands of your answers together and ask you, as you start to reverse policy, what your goal is. Are you going to be raising interest rates until you get inflation to 2%? Do you want to go below 2% so that on average you get a 2% inflation rate? And because you said we have to protect the employment part of your mandate, is there some sort of circuit breaker that would stop you from raising interest rates on the employment side?
So no, there's nothing in our framework about having inflation run below 2%. So that we would do that, try to achieve that outcome. So the answer to that is no. What we're trying to do is keep inflation expectations well anchored at 2%. That's always the ultimate goal, and we do that in the service of having inflation. We get to that goal by having inflation average 2% over time. And if inflation doesn't average 2% over time, then it's not clear why inflation expectations would be anchored at 2%. So that's the way we think about that. What was the last part of your question?
I was asking if you're protecting the employment side of the mandate, whether there's some sort of circuit breaker there.
Nothing like that. I mean, I would say you have a tremendously strong labor market, and you have growth this year at forecast to be well above potential. I mean, people are forecasting growth. If you think potential growth is around 2, most forecasts are significantly above that for 2022, and that's even with policy becoming substantially less accommodative. So the labor market's going to be strong for some time. Ideally, what we're trying to achieve is inflation getting back down to 2%, and we're trying to do that in a process that accomplishes, that will also leave the labor market in a very strong position. And no one really knows what that will take. Again, I would say that it isn't just monetary policy that's helping inflation get down. It'll be supply side improvements, and it'll be less fiscal impulse, in all likelihood. So, but monetary policy will do our job. It is our job to get inflation down to 2%, and a situation where the two goals can be in tension is a difficult one. But I don't really think they are here, though, because I think a really significant threat to further strengthening in the labor market in the form of higher participation over time is high inflation. And also, high inflation is taking away the benefits of some of these large wage increases that we're seeing now. So we do hope to achieve, and our plan is to achieve both of those goals.
If I could follow up, does the danger of tightening too much as policy works its way into the economy with a lag mean that you should go back to being more forecast dependent in making decisions rather than the state dependency you've been using as a framework for the last year and a half or so?
State dependency was particularly around the thought that if we saw a very strong labor market, we would wait to see actual inflation before we tightened. And so that was a very state-dependent thought, because for a long time we'd been tightening on the expectation of high inflation, which never appeared. And that was the case for a number of years. So in this particular situation, we will be clearly monitoring incoming data as well as the evolving outlook.
Let's go to Michael Derby.
Thank you for taking my question. I want to ask you, with the benefit of hindsight, and I realize, I mean, that is what it is, but do you feel that, monetary policy and fiscal policy maybe did too much to react to the crisis, and that part of the inflation problem that we're having right now is because the government response, collectively was more than what the economy ended up needing?
So I think it's too soon to write that history, really. But what I would say is this. If you remember what it felt like at the beginning of the pandemic, literally the global economy shutting down in large part, including our own economy, and people going to their homes for weeks on end in masks, and there are no vaccines, and it could be a really long time to get them, and
if you can answer the poll, that would be nice. So not so many people has answered the poll, but you can answer the poll and we can move forward from there.
You have economic act incredibly timely, very powerful. There'll always be flaws in these things, but in real time, it was a remarkable achievement. And we responded, and what we were able to do was, stave off a collapse of the financial system at the beginning and make time for what really needed to happen, which was the income replacement and then the recovery that Congress enabled with the CARES Act. So now that was a lot. And what we did was a lot. And now, what we have now is we have the strongest recovery of any country, and we have a recovery that looks completely unlike other recoveries that we've had because we've put so much support behind the recovery. And we're managing the relatively high-class problems that come with that, which are high inflation and a labor shortage. And these are serious problems, very serious problems that we're working as hard as we can on. Was it too much? Again, I'm going to leave that to the historians. But in 25 years, we'll look back at this incident, which will be a 2, 3, 4, 5-year period, and we'll say, we'll have a much better basis to make a judgment about the actions that people took. But it was all founded, though, in a very strong reaction to a unique historical event. And I guess I'll have to leave it at that. I hope I'll be around to see how that looks in 25 years.
Fair enough. Thank you.
Thank you. Let's go to Jean Young.
Thanks, Michelle. Chair Powell, some investors are expecting the yield curve could flatten or even invert after rate hikes begin. Would that worry you? And how important is that risk in the Fed's consideration for adjusting policy?
So we do monitor the slope of the yield curve, but we don't control the slope of the yield curve. Many factors influence longer-term interest rates. But it is something that we watch, and you will know that from when we had this issue a few years ago. And we take it into account along with many.
So let's go to the charts then, people. Then Jerome Powell, we're going to leave him at that. So what was the takeaway? What did you learn today? Let's see if you have been paying attention in class. That's all great. As gold was dropping downtown, I said gold dropping, don't buy gold. If you want to sell it, you need a pullback by all means, ladies and gentlemen. My name is Eivindfx. I'm a Forex trader for over 8 years, and I'm here to help you with fundamental analysis, technical analysis. If you have questions, please, at the beginning of this live, there was links to my strategy. If you want that, it is just to go back up there, but by all means, we are going to go through some charts, and I cannot go back. So the pinned comment is my strategy. The next pinned comment in the pinned comment is my Discord channel if you want to join there for free. So, well, I want to ask Powell about charts or Forex. Yeah, we shall also ask him. Maybe we should sign up for a questionnaire next time and see if we can get in there. Is there any chances for Euro USD, Aussie dollar, pound dollar, New Zealand dollar for pullback? Okay, and then we are going to G1 West says is gone. I just want to say one thing for all everyone. Thank you guys for everyone who has subscribed today. 5,593 people. I really love every single one of you. I wouldn't be here so please, thank you. Thank you for everyone who's been here. Can you teach me to do the splits? How flexible are you? Can't make Tuesdays. I don't know what you mean, Dwayne. Can you teach me how to do the splits? Split what? Split charts? This one? Or split what? Like the splits? Which splits? Ash says to the moon, to the moon, to the moon, to the moon, to the moon. Yeah, it is to the moon. I don't know what to say. I don't know why I'm not so enthusiastic. Okay, let's go back up again. Let's go back up again. We have just pulled off correct analysis, the analysis. We are getting so... Boom. We are right. We are right. We are right. So, what should we go through then? I saw that... Who was it who sent me that chart of me? Somebody sent that chart of me. Vinyak, yeah, you're gonna get your face there. So, yeah, fantastic. And now I look like a, is it a rabbit or is it squirrel? I don't know which one it is. Okay, let's go through the markets then, all right? Aussie dollar falling, ton of bricks. Okay, now we know. What did we say earlier? Up to 72. Did it come up to 72? No, it didn't. Okay, then we continue. Euro USD. Did it come up to the price we wanted? No, it didn't. Then it continued to fall. So, dollar. Currently going higher. Is it the highest high? No, it's not the highest high. It's soon higher. Can we expect a pullback, everyone? Can we expect a pullback? Pullback. Probably not. Yet. There is a couple of theories I have in my brain at the moment. We can just have a theory where we're just gonna go boom to the moon. No pullbacks whatsoever. The other one is a bit more slow one. So right now we just need to analyze where the pullbacks are gonna go as to how deep are they. That is gonna show me, so within the next hour now, it's gonna show me how deep are the pullbacks going to be. That's gonna determine how I need to treat this one. But we have Monday. We have every week of the day of the week to look for pullbacks. Now, if you are not in this move already, Arctic Dad, I missed your joke. Sorry. Arctic Joke, what did you say? Today I started crying when my wife was cutting onions. Onions was such a good dog. Jesus. Oh, poor onions. So, that's dollar. So, if you want to buy it right now, have fun with that. I'm not going to do that. But I want to, I don't know, 15-minute time frame maybe. There's no pullback on 15-minute time frame. And there is no pullback on 5-minute time frame. So, still good to the upside, okay? So, we just have to wait for a pullback here then. Going back to 1 hour. On the S&P 500, we are tanking. We are tanking. Not as strong as I anticipated to be, but it still falls. So, market is still falling as long as it's still below 45. 445, 4450. We are going to go downtown. So, at this moment, not what I want to see, but it is what happened. So, if you're thinking of any pullbacks, probably somewhere up to level of 43.60 or up to 44.0. Those are kind of what you're expecting right now, but I'm just waiting. If it's going to be tomorrow, if it's going to be next week, if it's going to be next month, that we are making higher highs. But so far, nothing to do here. Good, so I can open trades again. Yeah. I like your house is filled with laughing gas. Poor dog. Poor Dodge. Took the missus to a wife swapping party. Took a missus to a wife swapping party. I got a set of sockets banners for her. Let me say it again. Took the missus to a wife swapping party. I got a set of socket banners for her. Bro, can I buy oil and Nasdaq now? No! You cannot do anything like that. Jimmy James says, gold for the win. Yeah, good if you sold it. Tronny says, I'm wondering the same thing, says Edge. SJ, I'm wondering why yen is getting so strong. I guess it's risk off more than anything else, but I will look into it. So, stock market going higher. Nasdaq going, sorry, the stock market going lower. Nasdaq also probably also going lower. So that's another one that we just need to look out for. Just trying to see if I can move things around. Is there another one here? FOMC press conference. Tja, I can take it away, I guess. I'm just seeing what is spending my energy at the moment. We're spending. Cool. You're gone. Next part? No. Why did gold drop? We'll go through that one. Okay. I'm loading up stocks on my long-term portfolio. I'm loading this pullback. Good. So, gold in falling, good. So, stock market is falling. I'm personally not going to buy it. Happy Day says he's loading up. That's okay. I'm not going to take that away from you. 10-year T-note is skyrocketing at the moment. Aussie dollar is falling, but pulling back a bit. Euro dollar came down to 12.43. Gold was requested a long time ago. So, gold has been falling for the past hour. It has continued to drop, but it has still just stopped around 18, 13, 18, 14, 18, 15. Now, I don't know how far of a pullback you're going to get, but you want to look into if it does, then you can start sell. Then you can look for sells. But other than that, I can also be okay with breaching that low before going back. I just need a resistance. I just can't sell lower lows, right? What is your US 10 price? US 10 is 1.849 at the moment. Why did gold drop? Gold dropped because we had a hawkish Fed. Fed said that we are going to, or they are practically ready to rate hikes in March. He also said they're going to go by meeting and see how things goes, blah, 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 blah. But he mostly came and said that we have a very strong labor market, we have a strong inflation, everything is strong across the board. Nothing was weak apparently today. So it's a very strong economy. That's why they have to increase interest rates. You're welcome, bro. BTC is falling. Let it fall. Pound dollar is coming in right now. So I said earlier today, 13.17 is aggressive, but that's a level you can sell at. Okay, it fell. 13.35 was a level also to sell. I am not in any of those trades whatsoever because I am bullish on pound dollar, also on dollar itself. So right now, we're currently falling. Okie dokie. So you are either looking into next week where you're looking into selling around 135 and then shorting it again. If it makes a new lower low today or tomorrow, then you want to coming back up to 134.50. 134.50 or 135. That's price levels, not pivot levels. And pivot level is 135. So right now we're just waiting for it to decide if it's going to go lower or not. But I'm not trading pound dollar because I'm bullish on it. So wait on it. Euro dollar is now making a new lower low. 113.50, which is the level up here, is now getting invalid. Now we need to make a new plan. And the new plan is that we should probably sell 1300 next week. We have now reached target, so we can now go back up again and sell it next week. or it can just continue falling. I don't care too much because it still will come back up on either Friday or Monday or vice versa. Remember, we can have 100% retracement off the current move. That is no problem for the market to do. So just be aware that you don't sell right now, you wait patiently, and you take it down. I will tell you in the lives or in daily setups, mostly likely in daily setups, where I am and when I'm going to sell next. Do not worry, you will be told. Any idea? What's the sell zone on the euro? 113. Mate. Great price for gold, says Dot. Yeah. Hensley. Dorothy, probably. Pound dollar, just did it. You have to go back a couple seconds. What's your view on gold? I think gold is now probably going to fall. I think London will pull back today's opening high as they missed the boat. Then again, London will sell off again. Okay. Then we have a thing there for London Open that it will come back up for London, and then it will sell in either London session or in New York session tomorrow. Euro USD, Eivind, in the chart, Eivind, in the chart USD, which pivot points did you activate now? It's the free version, the one that you have access to. Weekly, at the moment. Patrick, please tell me about oil and Nasdaq. I'm looking for a buy. You cannot buy a falling market, bro. I'm sorry. I can't tell you, and I'm sorry, that's not what I will not. If you give me $1 million, I will not buy Nasdaq. I will not buy gold. That's my answer. I will not. If the Fed is hawkish, why is the stock market also dropping? The stock market is dropping because interest rates is potentially increasing, which is the same as higher financing costs, or it's higher interest rates on your loan. So financing cost goes higher means lower profits. That is a P. Lower profits. Higher interest rates equals higher financing costs equals lower profits equals stock market going down short term. It will come back at some point. I don't know if it's going to be tomorrow. I don't know if it's going to be next month or next year. All right. I have already mentioned pound dollar. For those who mentioned pound dollar, you can catch a falling knife. Aussie dollar, would you buy? Not in a million years. Not in a million years. Are you bullish on pound dollar? I'm bullish on pound and bullish on dollar. So I can't trade pound dollar. So Shaik, the thing is, if you're going to make consistent profits and returns, and it's out of love, by the way, Shaik, is that I won't buy something that's falling very hard. I will have to wait. If you want to sell it, you can be my guest. You can help. I will. I can. We can talk about that one though. But buying, no, I can't. Gold definitely fell and is currently at 1818. Xavier says, Casa, don't buy Aussie dollar. I think we haven't talked about Aussie dollar for a very long time now, that we are selling it, and it's been falling. If you want to be a buyer on Aussie, you need to have a full reversal. You need to be above 72 at least. Not 0.72, at least above this price here, before you even can think about it. So let me make a new chart, a very easy chart for you to understand. Okay? Currently, you need to make that move before you can buy Aussie. And right now, it is currently trying to make a lower low. That is not the time to buy pound dollar. Technical analysis, people. Technical analysis. That's what you need to go through. Thought they said it would stay the same until March. Tyler. So, the thing is about market anticipation. Market is now pricing in right now the rate hike we're going to have in March. The market is right now pricing in what's going to happen in the future. Right now, we know we are going to have rate hikes in 2022. That's what they're pricing in right now. Because it's like your mother tells you, you're going to have candy on Saturday. Then you will be excited. The market is the same. They will be excited. Just buy puts every time he makes a meeting, easy money. That's a good one, corrector. That's a good one. Do we have a Zoom meeting right now for all? No, I don't have a Zoom meeting right now. I'm here right now. So, USD CAD rose. I'm sorry. Well, not I'm sorry. I'm not really sorry because I didn't call it out. But it's higher. For those who wants to know. If you bought it, totally up to you. Lördags godis. The interest rate should already be 15%. This is going to die. Jimmy James, you're onto something. The inflation right now is absolutely crazy. It's absolutely bananas. I would agree. Okay? Pound yen, fall a bit. I wanted up to 155. Didn't get it, but okay, cool. Whatever. New Zealand dollar, new lower low. Boom. Another one we are right about. Didn't come to the sell level today, but we can make a sell level tomorrow. And I think 66.50 is the target. Boom. Again. Oh, yeah. Yeah, we'll do that. Pound New Zealand. Just looking at it for 2 seconds. And then I will help you out. So how should I help you out? I wouldn't, Johnny. I wouldn't, Johnny. It's too range, too much of a range. But if this range is broken and it goes higher, probably higher high, higher low, coming back down to support, and target is up to 2.03. 2.03 is the target for this week. So yeah. Have fun higher. That's the one thing I can say about that. Pound Aussie. I wouldn't trade it for $1 million. It's range. It's not going anywhere. It's just up and down. USSR. Ash. What did you do here, Ash? What did you do? What did you do? What did you do, man? What did you do? Where's Hardik? Hardik, where are you? So sell on New Zealand dollar range next week. Yep. USSR, Ash, tell me, bro, my lovely bro. Oh, my mother had called me. So Ash, while you are having fun with that, I'm probably gonna just make a phone call. Family always comes at some point, so I'm just gonna make that phone call. No, probably not. Okay, cool. So we are going to go Spotify. Now you can see what I listen to. I listen to Adele and girls and stuff. That was my mother, so always family first, bro. Always family first. No emergency so far, at least. Then nobody died so far, so that's good. Praise the Lord. Hallelujah. Amen. Yeah, so waiting for higher high, I would agree on you. Just take away the previous, yeah, so that looks like a good buy now. But maybe like a small pullback tomorrow, maybe, where we can get maybe the daily, maybe or something. So maybe down to 1528, or or just go higher high, higher low, and then back to that support. So one of those. So if we have a higher high today, then maybe a pullback tomorrow or something. All right, good. Swissy pairs, please. I don't have too much to offer on Swissy pairs. Swissy is manipulated Aussie Swissy falls. Pound Swissy is rising. Look for buys. USD Swissy is rising. Look for buys. New Zealand Swissy, look for sells. CAD Swissy, look for buys, I think, actually, to be honest. But yeah, so Swissy doesn't have their own. It's not really something that I would like to see, like to do, because Swissy is manipulated by the Swiss National Bank by all means. So it can go up and all of a sudden, boom, 100% back down again. If that's what you want to do, cool, have fun. But I don't. I hate it. I hate Swissy. To the guts. But if anything, buy dollar Swissy, but I would rather do Aussie dollar or Euro dollar or New Zealand dollar way before you use the Swissy. But if you have to, you have to. So, Mr. Who, thank you for everything I've learned here over the few days. Thank you for the live coverage. Thank you very, very much. Very, very much, Patrick. I'm actually showing everyone my... Okay, cool. Do you trade silver? No. And I wouldn't. Could you show your pivot settings for entry and targets? So if I was to sell euro dollar tomorrow, I'm going to go to my pivot points. And I will... Probably the new one, as you all understand, probably. I will go to this one, and I will go to 1 day for tomorrow, and I'm going to put it at bearish. 1 day, 1 bearish. A style is no OOP, and I have bullish exit, and I have this custom color here. That is this one here, and I'm going to add it for you. So that is what I have at 35 opacity, and then I just sell, and then just sell as we go, kind of a thing. So yeah, good to go. Good to know. I want to thank you for your work and that you help us. Thank you, MP. You're welcome. We are welcome, SG. So, and Casa Luis did not spell my name correctly. So, Aussie dollar tomorrow, maybe looking at 77.44. Euro dollar maybe it's 12.74. New Zealand dollar maybe looking for 66.72. What else was I supposed to look at? USD ZAR. I did USD ZAR. Goes higher right now. Yeah, okay. And then we are looking at a gold. Gold is here. Gold has still just stopped at 1816, but maybe coming back up to 1828. Maybe. A thing of tomorrow. I don't like that one, so I probably would just wait for another day, but still 1828 is definitely the resistance. Oil has made a new high, is now coming down. Are you going to buy that tomorrow? That's totally up to you. Nat gas went higher, came back down again, and we are back to loss again, Harold, I guess. So I don't have any directions here. I don't have any trade setups. It will just do whatever it wants to do. So if you want to buy it tomorrow, have fun with it, I guess. But I'm not going to at the moment. I have other things to look out for. And Aussie yen made lower lows at least. 81.60 maybe. CAD yen, nope. Euro yen, maybe 128.80, maybe. I don't like it. I would probably, for all these, just want a bigger higher high before again. Yeah, I'm just going to say wait on yen pairs. Why is yen strong? Because dollar is strong, because that's the risk at the moment, going towards the strengthening the risk sentiment at the moment. Risk off. Trony says, Eivindfx, thank you for everything. Thoughts on Bitcoin? I want to be bullish on Bitcoin, and Bitcoin is currently falling a bit, so it's coming down to a better price though, but it's still bearish, so I'm like, I don't know, maybe. It's a maybe. It's a maybe, but also it's good. It's good. It's still good. If you're a scalper, that would probably be a good buy right now, and just wait for it to go higher. CAD yen. I know, Michael. I know how you're looking at me, and you sold it. Congratulations. I wouldn't, but that's all on you. I would say maybe wait for a new lower low, or for it to come back up again and then sell it again. So right now it's at no man's land. It's probably in a good buy area, by the way, if you want to buy it, but I wouldn't. But so right now, let me do that one though. I'm not going to buy it. I'm not going to tell you to do it. But if you're saying that you are a nice human being, I will probably do that for you. But that's all. That's not going to do anything else for you. Okay, cool. Then that one. Batman did it. Batman. Okay, cool. There we go. That's a buy area. That's a sell area. And then we shall see what works out. I believe that CAD yen can still go down because of yen strength. But right now, that's not a sell price. So you might look for that one. And if you are a buyer, it's an aggressive buy. It's an aggressive buy, by all means. So you take profits daily, or you keep adding position, take profit on weekly. I do take profit on weekly profits. No, I haven't mentioned it. Discord has crashed. Has it crashed? What happened? I'm still here. I think, maybe. Am I still here? Hello. I'm still here. So yeah. So for those who got that notification, I'm still there. All right, so what's the setups for tomorrow, bros? What's the setups for tomorrow, bros? $71.45, $71.28 is scalps for tomorrow, if that works out. I don't know if I want to, well, whatever. 12.76, 12.63. I'm not going to give you the exact price anyways, because I don't want to be slapped by anyone. But a normal level, generally speaking, that's what you want to see. So that's what you want to see tomorrow. Same thing here. You just want to have a pullback to 66.72 or something like that. 66.52. Up to back to resistance or somewhere before falling again. Euro New Zealand looks to be a buy, and CAD is just gone. So we'll have to look at that one tomorrow. And gold, yeah. So I will rate out gold tomorrow, see what it does, if it goes crashing down or just a bit down. We still have stopped at 18.16. It can continue falling later on in the evening. I don't know. I don't care. I don't see that. Is this the right time to buy altcoins? I am not an expert there, bro. What's your favorite pair to trade for the rest of the week? Aussie dollar, Euro dollar, New Zealand dollar are probably my favorite for the next week. I am happy that you are here today. I am happy that you came all along until the end. Or if you came here now, congratulations. I'm just going to say a couple of things. First of all, dollar strength. Second of all, dollar strength. Third of all, dollar strength. Fourth of all, I have birthday 4th of February. So in a couple of weeks, I have asked you for some input, what you would do. And I hope that you send 10% of your profits to me. So also my work bears fruits. Joke. But yeah, so for those who has made money or have made correct trade plans, I am deeply proud of you. I'm happy for you. For those who hasn't, I am here to help you again tomorrow at 2 p.m. just before as London opens, as New York opens up. I will be here. So have a good day. Have a good night. I love every one single one of you. Mwah. Have a good day.